Today we will cover the different types of mutual funds, a key topic on the SIE exam. Understanding these fund categories is crucial because the exam will test your ability to recommend suitable investments based on a client's objectives, risk tolerance, and time horizon. Let's start with equity funds. As the name suggests, these funds primarily invest in stocks or equities. Their main objective is capital appreciation, meaning they aim to grow the value of the investment. An exam question might describe a young investor with a long time horizon and a high risk tolerance who is saving for retirement. This investor is a prime candidate for an equity fund. Within this category, you'll find various subtypes. A growth fund, for instance, will invest in companies expected to grow faster than the overall market, like technology or biotech firms. These are often more volatile. In contrast, a value fund seeks out stocks that the fund manager believes are trading for less than their intrinsic worth, hoping for a price rebound. An income equity fund would focus on established companies that pay consistent dividends, which would be suitable for an investor seeking regular cash flow in addition to some growth potential. Next are bond funds, which invest in debt securities. Their primary objective is typically to provide income to investors in the form of interest payments. The exam loves to test the inverse relationship between interest rates and bond prices, and this applies to bond funds as well. When interest rates rise, the value of existing bonds, and therefore the NAV of a bond fund, will typically fall. The risk level of bond funds varies dramatically, a common area for test questions. A U.S. government bond fund is considered very safe because its underlying assets are backed by the full faith and credit of the U.S. government. A corporate bond fund carries more credit risk, as the issuing corporations could default. And then you have high-yield bond funds, also known as junk bond funds. These invest in bonds from companies with lower credit ratings, offering higher potential income, but also carrying a much higher risk of default. A trap to avoid is thinking all bond funds are low risk. What if an investor wants a mix of stocks and bonds in one package? That's where a balanced fund comes in. These funds maintain a specific allocation, such as 60% stocks and 40% bonds. They offer the growth potential of equities and the income and stability of bonds, providing instant diversification. The SIE exam might present a scenario with a moderately risk-averse investor, making a balanced fund a suitable choice. Then we have money market funds. These are designed to be a safe place to park cash for short-term needs. They invest in highly liquid, short-term debt instruments like treasury bills and commercial paper. Their goal is to maintain a stable net asset value, or NAV, of $1 per share. A very common exam trap is to confuse a money market fund with a bank's money market account. Remember, a money market fund is a security. It is not FDIC-insured, and it is possible, though rare, to lose money. An investor saving for a house down payment in 6 months would be a perfect fit for this fund, due to its low risk and high liquidity. Finally, let's discuss a concept that applies across these categories: index funds. Unlike the actively managed funds we've discussed, where a manager picks securities to try and outperform the market, an index fund is passively managed. Its goal is simply to mirror the performance of a specific market index, like the S&P 500. For example, an S&P 500 index fund will buy the 500 stocks in that index in the same proportion as the index itself. Because there's no active management team doing extensive research, index funds typically have much lower operating expenses, or expense ratios. The exam will test your understanding of this passive versus active distinction. If you see a question mentioning low fees and tracking a benchmark, your mind should immediately go to an index fund. To remember the core suitability of each, think of this phrase: go for growth with stocks, find your income flow with bonds, balance them for a smoother ride, or park your cash for the short-term tide. This connects the investment objective directly to the fund type, helping you quickly identify the right answer when you see a client profile on the exam.